how do you see new age investments like crypto, like option trading? All of that is gaining so much of popularity amongst the youth.
I don't know, Siddhesh. I think, you should always stick to your guns. There are multiple ways of making money, and I've told this on multiple forums. Even gambling is a great way to make money. People who win it, right?
True.
Both of us know someone who is so good at poker, and he's rated as one of the top poker players in India.
Correct.
And his investment is probably 100,000 at any given point, and his winnings are about 2.5 million, right?
Yeah.
Easily at any. I'm talking about an average. Great investment for him,
Yeah.
right? But can everyone do it, right? The answer is no. Can you value his talent? Qualitatively, yes. Quantitatively, no. Right? You cannot do a financial modeling and say that my 100,000 worth of investment into this poker game is going to be this much, right?
Correct.
We always have believed a lot in future cash flows. Why? Because those future cash flows, when discounted at a particular required rate of return, you can arrive at a valuation. And that value, whether it matches the market value or not, is something that you have to see.
Correct.
If it is way above the market value, you should know you should go long on this asset class.
Correct.
If it is way below the market value, that means the markets are factoring in a premium for this asset, right? While you think the actual intrinsic value of this asset should be much lesser than what the markets are determining it.
Correct.
That's why you either go short or if you just avoid that asset altogether. All I'm trying to say is that 90% of the industry at any given point of time is just focusing on finding out the intrinsic value of an asset. Because once you know what is an intrinsic value of the asset and you see what's the market value of an asset, you have a very clear-cut decision whether to pick that asset in your portfolio or not. Now with something like, say, crypto, I don't think there are any tools to value that asset because it's a demand-supply game. Purely from a valuation perspective, I don't think I have any method to value that asset class and understand what is the right price that I should be paying for that. So in that case, I'm completely dependent on the market price and faith.
Correct.
That I pick it up at a particular price that the market is quoting and it will still make money for me. That's number one. Now, there are obviously other asset classes, as you rightly said. There's private credit. There are various hedge fund strategies which revolve around options trading.
Correct.
The long short. Now, for us, I think the game has been very simple. We work in a very reverse way. We try to understand and to revisit the client's RRTTLLU. And we figured out that most people are quite happy making double-digit net of cost, net of tax returns.
Very well said.
Now, once you try to aim at achieving that double-digit net of tax, net of cost return, which can be 10%, which can be 12%, most people are very happy with that. Let's understand what that double-digit return does to your portfolio. At 12% rate of return, your portfolio doubles every 6 years. It quadruples every 12 years.
Correct.
Right? So that's how the money grows at that pace. And it is very difficult to earn that 12% consistently over the longer period of time. It is. Okay? Most of the indices worldwide have given less than that kind of return over the longer period of time. I mean, at least till January, people were talking about S&P 500 returns over the last 1 year because it had given upward of 20-25%. People were talking about the last 10 years because it's 15%.
Correct.
Now you try to stretch the time period and see what are the S&P 500 returns in the last 20 years.
Correct.
Less than 10%.
Yeah.
You look at what Sensex has delivered, what Nifty has delivered, right? Now, obviously, when you are happy with a 12% kind of return, I don't think you need to be adventurous. You need to get into zones which will just give you the excitement of investing, but may or may not be productive from a risk to return perspective. What is risk over here? The risk over here is not market risk. Market risk is just the risk of the volatility, the risk of you going through different market values, which are higher or lower than your investment cost. That's market risk. But we are not only talking about market risks, we are talking about credit risks. We are talking about the chances of your capital entirely getting wiped out permanently. Okay? Yes. That is something that I'm not okay with. So whenever I talk about risk appetite, I don't say that you should be okay with, someone who has a higher risk appetite should be okay with losing his money completely. That's not what I advocate. I say he should be okay with volatility. It's just that if I am quite happy making that double-digit net of tax, net of cost return, I don't even need to look at it. From our perspective, I say if you need 1% or 2% higher returns, put 10% more into equities. That itself is going to do the job for you. You don't need to invest in asset classes where there is a lot of uncertainty and there are a lot of risks that you don't understand. I see a lot of financially engineered products coming into the markets, and those are honestly good market anomalies. That's what I call them. Because nothing can beat your equity long approach if you really have the longer time horizon and you are valuation conscious. What do we say? There's no one above God. I say in our capital markets, there's nothing above valuations. Valuation principle, you stick to it, you're going to make superior risk adjusted return. So don't take my reluctance to look at such kind of alternate asset classes like commodities or currencies or long short or different hedge fund strategies, private credit as something that is sacrosanct. I probably may look at something if the risk return ratio is really favorable to the investors. Right now, I don't think it is. We use fixed income as a pure balancing tool in the portfolio. We don't use fixed income to chase returns. And that's why there's no space for credit. In our portfolios particularly, at some point of time, will we have credit in the portfolios? I don't know. The answer depends on the risk to return ratio.